Water is the new frontier of risk and value in America, and headlines are catching up to reality. From drought-stricken farms in the West to thirsty urban centers in the Southwest, water rights increasingly drive decisions that look like financial assets. Investors watch rivers and reservoirs as if they were stock charts because scarcity can lift prices, constrain supply, and trigger long-term contracts that shape whole industries. As climate patterns shift, government policies tighten, and infrastructure lags, the question becomes not if water matters, but who holds the tap when demand spikes. This video explains why water rights are moving from local policy fetch to global balance sheet. Water rights are not water itself, but the legal permission to use a share of a water source. In many Western states, riparian and appropriation doctrines allocate scarce flow to farmers, cities, and industries through a web of permits, contracts, and seniority. When a river runs low, those with older permits still get water first, while newer users compete. Prices reflect this scarcity as basins sell seasonal allocations, transfer rights, or bundle water with land. Think of water like a long-term lease on a finite resource, governed by courts, agencies, and a patchwork of state regimes that vary by watershed. Water governance in America grew out of frontier scarcity and legal battles over rivers like the Colorado and the Rio Grande. Early settlers relied on public trust doctrines and state appropriation laws that separated land titles from water rights, creating a hierarchy of senior rights. The Dust Bowl era reinforced the importance of legal certainty, while the 1902 Reclamation Act funded irrigation projects to turn arid land into farmland. Modern agriculture, growing cities, and energy producers then stitched their futures to river flows through intricate transfer markets. Changes in climate, population, and infrastructure continually redraw the map of who gets water and when. Markets are starting to price water like infrastructure, with trading platforms and weather-driven volatility. In California, water brokers report seasonal allocations moving through multi-billion-dollar cycles as drought tightens supply. Across the West, farmers hedge against price spikes by leasing water or securing intertemporal contracts, while utilities evaluate large-scale transfers to meet urban demand. Investors watch commodity indices that include water futures settled on rivers and major reservoirs. Private equity and infrastructure funds invest in storage, treatment, and distribution, betting on population growth, agricultural demand, and climate shocks that tighten the feedstock timeline. Regulators debate pricing transparency, risking political resistance and market distortions. Who wins and who pays depends on geography and industry. Agribusinesses with senior water rights win when cycles tighten, while newcomers face higher lease costs. Utilities vie for storage capacity, municipal bond markets absorb infrastructure spend, and manufacturers face unpredictable energy and process water costs. Insurance and credit ratings adjust as droughts threaten crop yields and plant uptime. Pension funds and sovereign wealth funds increasingly view water as a core long-horizon asset, while small family farms struggle with capital access. The ripple effect touches construction, beverage, and food processing in surprising ways. Tech firms' supply chains adjust as desalination, recycling, and reuse become part of resilience planning. Water scarcity sits at the crossroads of climate risk, urbanization, and global supply chains. Drought in the American West interacts with growth in Asia and Europe through commodity markets, trade policy, and investment capital seeking diversification. Federal and state budgets compete with drought relief and infrastructure, shaping subsidies, water pricing reform, and river management rules. Population growth means more mouths to feed with less flow, while energy systems rely on hydropower and cooling water. The result is a macro tapestry where water becomes a currency that can affect inflation, debt markets, and geopolitical stability. Central banks monitor risk channels as drought cycles influence agribusiness credit and sovereign budgets. Smart money is testing waters through blended portfolios and long-duration infrastructure plays. Pension funds and sovereign wealth funds partner with developers to secure storage and treatment capacity, hedging drought risk with revenue guarantees. Public mutual funds and ETF issuers increasingly add water-related products, growing assets under management as retail fans stay curious but cautious. Corporate treasuries use water risk disclosures to guide capital expenditure, while private equity funds bet on desalination, groundwater management, and leak detection tech. The chorus is cautious diversification rather than a single grand bet on a drought future. Regulators scrutinize pricing overlaps and conflict of interest in broker networks. Every thesis has risk, and the bear case for water assets is not a single downside, but a constellation of threats. If climate outcomes unexpectedly improve in key basins, or if storage projects underperform, prices could deflate and liquidity could dry up. Political backlash over water pricing reform can stall transfers and trigger lawsuits that freeze markets. Technology breakthroughs, such as breakthrough desalination or large-scale efficiency gains, could reduce demand, undermining upside. Over-reliance on a few basins creates concentration risk, while rating agencies may downgrade revenues in stressed agricultural districts. Finally, energy prices influence pumping costs and profitability across water assets. Retail investors can participate through simple, low-cost exposure rather than trying to forecast droughts. Start with broad-based water-related ETFs or infrastructure-focused funds to gain diversified access. Use position sizing and stop losses to manage climate-driven volatility. Read impact reports from utilities and agribusiness names to understand exposure to water risk. Look for companies with clear water efficiency initiatives, strong permit portfolios, and transparent governance. If you own farmland or business assets, hedge water price variability with insurance products and long-term lease agreements that lock in revenue streams. Diversification across regions reduces local storm risk and plus sustainable yields. Looking ahead, water rights will likely become more integrated with finance, technology, and risk management. Cities will test trading, storage, and recycling at scale, while agriculture consolidates senior rights into efficient water portfolios. Policy will move toward transparent pricing. Public water utilities will modernize through data-driven decisions, and investors will demand resilience metrics alongside yield. The most scarce asset in America may not be a single stock or asset class, but a dynamic system of rights, incentives, and governance that stretches across regions and border. If you found this valuable, subscribe to The Commodity Brief for weekly insights on alternative assets and commodities.